Okay, so hello and welcome. Today is October 1st, a new quarter, a new month, and a new day. We're going to talk about the ECB and the non-farm payrolls. We're going to prepare for them in the wake of the fourth quarter. My name is Yohay Elam. I founded ForexCrunch. Just a quick background, I used to be a retail trader and computer programmer. I founded ForexCrunch back in 2008. It's a website on Forex, of course, that focuses on fundamental analysis. I also touch technicals, but fundamentals are what's important. Okay, so this is what we'll cover today. The current state of euro-dollar, as we know it's down, but we're going to see exactly how. Doing whatever it takes, what happened so far from the ECB. And we're going to have, of course, the ECB preview, and then we're going to move to the other side of the Atlantic, focusing on the non-farm payrolls, which is on Friday, and then we're going to have a Q&A session. So here are the current conditions in euro-dollar. It's been falling. It reached a peak of 140, nearly 140 in May. Since then, it's been going down, and the losses have accelerated recently. Key big lines to watch, 130, 127.50, which was the double bottom, 126.60, which is where this broken uptrend began back 2 years ago. 125.70, which is the most recent low, the round number of 125, and 124.60. Of course, there are many more lines. So why did euro-dollar fall recently? The main reason is monetary policy divergence. We can see here Mario Draghi and the former Fed chair Ben Bernanke. Now the Fed is headed by Yellen. And what does this mean? Basically, the European Central Bank, the ECB, is set to keep interest rates low for at least 2 more years, means end 2016, and add more measures, ABS, TLTRO, and perhaps outright QE. That means expanding its balance sheet. On the other hand, the Federal Reserve is going to end quantitative easing this month, QE3, and is expected to begin tightening to raise interest rates somewhere in 2015. And it took the markets quite a long time to respond to this, but they did wake up and they continue responding, and September was certainly exciting. So the fall, the ECB surprised last time with further measures in September after it announced big measures also in June. That was one side of the equation. The other side was the US dollar gained across the board despite some weak data, namely last month's non-farm payrolls. But in general, it was a very good month for the US dollar. It gained across the board. Of course, some currencies did worse and some did better than others. The euro was one of the big losers. So euro dollar is consistently falling, making dead cat bounces. That means when it does make some kind of correction, it's usually a very, very small one. And it also lost long-term uptrend support, which we showed beforehand. What is the state of the euro? We have worries about Germany and France, stubbornly low inflation. Russia is still present, even though it's not in the big headlines, and a poor TLTRO. We're going to talk about all these topics right now. So, Germany, the Eurozone's largest economy, it experienced contraction of 0.2% in the second quarter. All in all, the Eurozone had a flat growth rate in the second quarter, and it didn't come after a strong one in Q1, which is only 0.2. In Germany, unemployment is on the rise. According to recent data, it's still low, but it's on the rise. Business confidence is falling. The IFO and the ZEW are both heading down. German PMIs, purchasing managers indicators, did not point to a weaker growth to contraction, in Q2. And now German manufacturing PMI is in contraction zone. This is really fresh data from this morning. France, second largest economy in the Eurozone and Europe in general. There's a political crisis in France. The president there has historically low approval ratings. They refuse to adjust to the European guidelines, the Eurozone guidelines. They experienced, I think, 3 quarters of flat growth. Unemployment also there is refusing to fall. And if these two countries cannot lead the Eurozone forward, then we're in trouble. Low inflation, that is actually the main mandate of the ECB. We'll also talk about this mandate later on quite briefly. But anyway, despite the weakness of the euro since May, inflation, CPI, Consumer Price Index, headline inflation, is at 0.3, the lowest since 2009. Core CPI, excluding energy, food prices, also at the lowest levels, 0.7, the lowest since before the crisis. German inflation specifically is also low, it's at 0.8. Spain specifically is experiencing deflation, outright deflation, a fall in prices year over year, not for the first month. Low inflation is a result of lower energy prices, glut from Russian sanctions, we'll talk about that soon, and no help to inflation from banks. Banks are lending a bit more, but it's still very early signs. Of course, the main issue is that low inflation results also from weak demand from a weak economy in general. Russia, the crisis there is still not over. The European Union, especially Germany, is reliant on Russian gas. It means this threat that Russia will cut supplies is always out there. There's significant trade with Russia in general. We had sanctions from the West, from the European Union, the United States, on Russia, and counter-sanctions. Counter-sanctions include food. Russia had a ban on imported food, and this also makes food prices cheaper and makes inflation lower. So it already hurts German business confidence, this tension with Russia, and we have shivers from the Cold War that we didn't have for quite a long time. But at the moment, Russia is a bit under pressure because its reserves are falling. So when it sometimes seems that Russia is winning, it's not exactly that. Anyway, we have to take that into account, that tensions with Russia still weigh on the Eurozone economies. Next, poor TLTRO. TLTRO stands for Targeted Long-Term Refinancing Operations. You don't have to remember that. You can just call it TLTRO, or cheap loans from the ECB to banks. But these loans are different from the previous ones in the fact that they are targeted loans. That means that the ECB gives banks cheap money only if they lend it to the real economy. However, in the first installment of this TLTRO, which was announced back in June and happened recently in late September, banks took up only something like 82.6 billion euros, which was below all estimates of even the most pessimistic economists and analysts. This weak take-up raises expectations for more steps from the ECB, and it triggers even more worries about the economies. I mean, if there's nobody to take the money, the Draghi is handing out basically for free, then the situation is quite dire. The next move, the next TLTRO, is in December. In general, towards the ECB meeting, what does the ECB do? European Central Bank sits in Frankfurt. It has a mandate to have it has a target of 2% or a bit below headline inflation. That's it. No core inflation, no employment like in the United States, just 2% or a bit below headline inflation. The target is being missed month after month. This low inflation means that the debt burden is heavier, and there is the D word, the fear of deflation. Deflation is when prices fall. Why is that bad? Consumers expect them to fall and don't buy. Factories produce less. People lose their jobs. There's less consumption. That's a vicious cycle. It did happen in the past during the Great Depression in the United States, and recently in Japan. Nobody wants to go Japanese. So falling prices are not always a good thing. We had the deterioration back in last October with the fall of inflation to 0.7%. The ECB reacted with a rate cut back in November to 0.25%. Since then it fell. The current bottom is 0.3 in July and also now in September, according to the preliminary figure. And core inflation hit, 3 times already, 0.7%, last time now in September. So the euro is, let's move on to inflation and the exchange rate. The euro is 10% weaker since May. It's around 126 at the time we're talking now. It almost touched 140 back in May. It's the lowest since November 2012. or September, I think. But it's still not enough to push inflation lower. The dream level for the ECB is somewhere between 120 and 125. Of course, nobody wants a currency that is too weak, but not too strong. And so far, the euro has been too strong for European exports and for European inflation. So far, the European Central Bank denied deflation. They only said that if a low inflation or low inflation stays with us for too long, it is dangerous. But eventually it did act. It explicitly connected monetary policy to the exchange rate and made the monetary blitz in June by cutting the interest rate, by setting the historic negative deposit rate, and made some steps in September. So Draghi also went forward between June and September. I think it was August. He said that the fundamentals of a lower euro dollar are in place. He explained that by saying that, well, what we know already, that the Federal Reserve is about to tighten, the ECB is loosening its monetary policy, and that he also said that flows into the Eurozone have weakened, have reversed. Since the statement back in August 7th, a euro dollar fell further, and since the measures in September, they, of course, accelerated. What did Draghi do last time in September? He cut the main lending rate, the interest rate, to 0.05%. He cut the deposit rate even deeper into negative territory from minus 0.10 to minus 0.20. And he did say explicitly that rates have reached their lower bound. So this is as low as interest rates can go. But the ECB, of course, has more tools and can talk quite a bit. In addition, in September, the ECB announced the ABS program. ABS is asset-backed securities. It's a program to buy all kinds of financial instruments, loans from banks, make banks free from all kinds of legacy burdens, and to help steer the Eurozone economies. And he didn't announce a number, but he did say that the idea is to enlarge the balance sheet of the ECB back to levels last seen in 2012. It means 1 trillion euros, and that's a lot of money. That's quite ambitious. As we've seen from the TLTRO, so far it's moving slowly. But there's more. There's the ABS and perhaps outright QE. We'll reach that in a bit. Next, so what will the ECB do now? Well, nothing, because they just announced a lot of stuff back in September. But it doesn't mean they cannot influence the markets, and Draghi certainly knows how to move the markets. So Draghi is likely to say things. What topics are on the agenda? More details of the ABS program, his view on inflation, his view on bank lending, the topic of QE, of buying outright sovereign bonds, which is much more complicated in the Eurozone than in the US, the UK, or Japan, but it's still an option. And of course, the exchange rate, the most sensitive thing. If he talks about the euro moves. So let's see the details of the ABS. He might place a timetable when it's going to happen. We don't know that yet. What types of instruments? So we know it's going to be some kind of bank loans or covered bonds, but what exactly is it going to be? How is it going to work? Perhaps the ECB is going to provide some technical details. But I suspect that Draghi is not going to talk about the size. ABS is just part of the tools to expand the balance sheet, together with the TLTRO and perhaps with QE in the future. But perhaps I believe the Draghi will not give a target to these buys, this ABS thing, in this meeting. They will just buy as they go. However, if he does give a number, last time he said sizable. So if he does give a number, if it's a big number, let's say around about 500 billion euros, I believe this will be euro negative, because like in printing of dollars in the United States with QE, also in Europe, if Draghi prints a lot of euros, it's going to be negative for the euro. It's going to devalue. If it's a small number, it's probably euro positive, because it means there are less euros in circulation. If he doesn't release a number, which is the base case scenario, the markets will probably move along to the next topic. The next topic, that we have here is the view on inflation. So, on one hand, inflation is still at rock bottom levels. As aforementioned, both CPI and core CPI are at the lowest levels they've been at. So, and they haven't been at these levels together. So this is really bad. On the other hand, a low value of the euro could push inflation higher, and that could happen quite soon because the euro fell quite a lot and Europe imports goods and the prices of these goods could rise with the weaker euro. This hasn't happened yet, but could happen soon. So what will he do? Well, I think he's likely to continue denying the danger of deflation. This will not be new and the markets will move forward. But if he does warn on deflation, the euro will crash because so far Draghi didn't say, when he was asked, each time he said there's no danger, but we have to be, of course, alert. So if he does warn, if he does scare us with the D word about deflation, it'll be euro negative, but the chances are small. His view on bank lending is the next thing on the agenda, at least from my anecdotal evidence here in Spain. Bank lending is on the move. Banks are more willing to lend money to businesses, to mortgages, and to personal loans, for instance, for buying a car or something like that. However, there was a really poor take-up in the TLTRO, so maybe perhaps banks are not that keen on lending. So we have here some mixed views, perhaps green shoots only. So I believe that Draghi is likely to show some optimism about the next TLTRO, to shrug off concerns about the first one. It's important to remember that at the end of the month we have the release of the stress tests, the bank stress tests. After this will happen, perhaps banks will be more relaxed because they won't have to hide anything or something like that, and they can lend more money in December. Draghi is also likely to push the ball to the government's courts, to say it's not only what the ECB can do, but also what the governments should do. He always does that. But if Draghi is worried about lending, yet again, it'll be euro negative. Number 4, leave an open door to QE. Draghi would prefer not to introduce QE because the Germans oppose it. Why do the Germans oppose it? Well, it's because Germany is against monetary financing, and even if you call it in different ways, if the ECB buys bonds of governments, it's basically lending money to these governments to do whatever they want, and making lending cheaper for governments and helping them with moral hazard to continue spending without thinking, and nobody wants that. In addition, there are legal issues. What bonds will you buy? Will it be the cheapest bonds, like the Cypriot ones or the Greek ones, or will it be the safe haven bonds, the German ones? There's no value there, but it'll sort of stem German opposition. It's a very, very complicated issue. I think Draghi would prefer to forget about that, but he might need to use it if there's no choice, because the amount of instruments, amount of financial assets that Draghi can buy via the ABS path is quite limited, so he might need to use it. In addition, just waiving it, just saying that we'll have QE is likely to weigh on the euro. So what I expect is that with all the trouble going on in the Eurozone, Draghi is expected to leave the door open to QE. Not saying that it'll happen, but leaving it open. If he does close the door on QE, expressing extreme optimism, then of course the euro is set to rise. I don't see that happening, but just this is a risk that can happen, that the euro will jump if he closes the door on QE. And now the most important topic, at least for us, the exchange rate. In the past, Draghi did mention the exchange rate as something the ECB watches and the risk to inflation, together with geopolitical risks, namely Russia, but also stuff in the Middle East. So, after a 10% fall in the value of euro-dollar, Draghi is probably smiling inside. Here we have a picture of him smiling on the outside, but He'll probably try to smile inside and not make a victory lap on that. The ECB officially doesn't have a target for the exchange rate, so I want to be very, very careful on that topic. What we could have is a hint that this fall is still not enough, given the fundamentals of the Eurozone. And what I think he'll do is try to hit the euro when it's down. It means central banks have the best influence on currency rates when they go with the trend, not against the trend. So it was very hard for the ECB or the Bank of Japan or any other bank to change the course of the currency and fight market trends. On the other hand, when it's going down, it's much easier to push it even lower, faster and stronger. We've just seen that from the Reserve Bank of New Zealand, from the central bank over there and the other side of the world. The governor of the central bank there, Wheeler, made a special announcement saying that the exchange rate is unjustifiable and unsustainable, even though it just before the month or two before the statement, the Kiwi fell quite a lot. I think the Draghi is going to take a page from Wheeler's book and try to push the euro even lower, saying that we still need a lower exchange rate, or not in these words, but something a bit more implicit, because a lower value of the euro is still necessary to lift inflation via important goods and to help the European economies via exports. And of course to avoid outright QE because he doesn't want to quarrel with the Germans. I would say that a value of euro dollar under 120 will probably be too much for the Eurozone because it'll make imported goods very expensive and it could trigger too much inflation perhaps, but we're still not close to this point. And even if it falls below 120, I think you won't hear Draghi complaining until it reaches perhaps an even lower level. So I believe he will try to push it down or at least keep it depressed, keep it from bouncing back via very, very subtle hints about the exchange rate and via leaving the door open on QE. So let's do a roundup of the topics for the ECB meeting for Draghi. No new measures are expected. He did a lot in September and rates have reached their lower bound. We're probably going to hear details about the ABS program, but without a specific number. The ECB will still fight lowflation or low inflation, but deny deflation. He's going to probably express some optimism about the banks, leave an open door to QE, and basically keep the pressure on the euro to avoid it from rising back and erasing the achievements that the ECB has so far, thanks to the ECB, thanks to the Fed. But the current levels of euro dollar are good. Even lower levels will be even more blessed for the Eurozone, and Draghi is expected, in my opinion, to keep it that way. All right. Now we're going to move to the other side of the Atlantic, to Friday's non-farm payrolls. So, what's going on in the United States? We had a rate decision in the United States back in mid-September. Yellen didn't say anything new. She tried not to rock the boat as expected. However, the Fed is a bit more leaning towards the exit. Yellen did provide some guidelines for an exit strategy. And if we saw the dot chart, it looks like rates are going to be a bit higher at the end of 2015. Everybody's expecting rates to move in 2015, but nobody knows exactly when. The Fed didn't change the key phrase of considerable time to a rate hike, but hikes could still come a little bit sooner or be a bit faster. The dollar is strong, according to that. Recent U.S. figures, other than the non-farm payrolls, growth was upgraded to 4.6 level annualized in Q2. This is really strong, but it compensates for a poor Q1. Q3 and Q4 are going to be more normal, somewhere around 2.5%. Jobless claims are quite good, are under 300,000. We're going to get the last read for jobless claims before the non-farm payrolls tomorrow at 12:30 GMT, just as Draghi begins speaking. Anyway, they're at their lowest levels since 2006. New home sales reached a 6-year high above an annualized level of 500,000. We had that information coming out last week. And on the other hand, consumer confidence is falling, and not all figures are really perfect. The most important figure that is far from perfect is the latest non-farm payrolls. After we had 6 months in a row of rises of over 200,000 jobs in the United States, last month was disappointing no matter how you look at it. So we had a disappointing rise of only 142,000 jobs. The unemployment rate, well, that was okay actually, 6.1%, but it did come on a background of a falling participation rate. Sorry, just 62.8%. That's the lowest level since 1978, 36 years. And it has been there before. And another key thing for the Fed, which has a dual mandate of employment and inflation, annual wage growth is just 2%. It did rise 0.2% month over month, but on a yearly basis, it's very slow, just 2%. So, what are we expecting now? A gain of around 225,000 jobs. That means that job gains are expected to return to their previous levels. This is, of course, expectations are going to be updated after ADP, jobless claims. So we had ADP just earlier today, and it came in line with expectations. So it doesn't alter expectations, but for the non-farm payrolls, but jobless claims tomorrow might move it a bit. So what else are we expecting? We're expecting revisions for August's poor number. Many analysts said that August sees big revisions. Usually it's hard to estimate in this month when people are on vacation. Unemployment rate is expected to stand at 6.1%. Participation rate the same as last month, 62.8%. And average hourly earnings are expected to enjoy another month of mediocre growth of 0.2% and remain around 2% year over year. So we're expecting more of the same and a return to normal. In general, if we get around the number let's start. If we get above 250,000, it's really positive for the US dollar because it's a big beat. If we get under 200,000, it's really negative for the dollar. But if we get a number in between, it depends on 3 other factors. The first one is the revisions I mentioned earlier. August is considered a volatile month. An upwards revision seems logical also with other data such as jobless claims. So many are expecting sort of a sigh of relief to come from a revision, to see that it was only a mistake, to show it was only a one-off. In addition, the participation rate, it needs to go up to pick up the slack. When less people are participating in the job market, that means the whole economy is suffering. So even if we have a low unemployment rate, it's only among a smaller portion of the population. So even though demographics have changed, there are still too many discouraged workers that are on the sidelines, and they can contribute to the US economy, but they don't because they can't find a job. It's against their will. So any rise, of course, will be positive. 63.2% would be very encouraging. The bottom is where we are now, 62.8, and if it drops even below this level, it'll be a new historic low, so it'll be terrible. The unemployment rate is less important. If it's 6%, 6.1, 6.2, it doesn't make that much of a difference. And the third thing, average hourly earnings, or if you wish, wage inflation. This is the actual source of core inflation. When people make more money, they spend more and everything goes up. It's not just energy prices, which move according to events in the Middle East or I don't know what, or food prices that are affected by droughts or by good harvests or things like that. It's still subdued at 2% year over year, wage inflation. Last month we had the same 0.2 as I mentioned before. But it's important to note that wages rise very slowly. People get a wage hike, salary rise only when they change jobs or around the end of the year. So we're not expecting something extreme anytime soon. All in all, if we have over 250,000, it's dollar positive no matter what. If we have under 200,000, it's dollar negative no matter what. If we have non-farm payrolls somewhere in between, then we depend on the revisions, the participation rate, and the average hourly earnings to go in the same direction. So if they are all positive, it's dollar positive. If they're all negative, it's dollar negative. But if each one goes its own direction, we'll have a mixed response, of course. But it's important to note, once again, we are in a really, really dollar bullish environment. So even if we have a disappointment in the non-farm payrolls, we're going to see a drop in the dollar, but it's going to be probably only temporary. We need a really huge disappointment in the non-farm payrolls on all accounts to have a change in direction for the US dollar. All in all, the US economy is still outperforming the world. The Fed is expected to tighten, even if there's another dip. So it could have a strong impact on Friday if we have a big disappointment, but we need a huge disappointment for a change of course for the US dollar. That's it. Now let's see if we have any questions. What do you think will be the next direction of euro dollar? Let's see if there are already some questions. What is my view on bond yields in the United States as QE ends? Well, it's been ending for quite a while with tapering, and so far US bond yields haven't really risen. I think they will not reach 3% in many months to come, only when there's a rate hike, I believe. There are other reasons that push US treasuries lower. First of all, the balance sheet of the Fed is still huge. It's not squeezing it quite yet, it's just stopping to expand it. In addition, there are worries about Russia, about Chinese growth, about Ebola, about what's going on in the Middle East. All this pushes money into the safe haven US Treasury yields, so I believe they will remain depressed. In comparison to German ones, the gap is actually widening, despite the fact that US Treasury yields are 10-year bond yields are around 2.5%, and they're not really going up despite the end of QE. German bond yields are under 1%. This gap makes the dollar more attractive than the euro. More questions? You're welcome. Any questions about the Australian dollar? It's been a popular topic on Forex Crunch. The pound, if you wish, now that Scotland seems like ancient history, even though it was only 2 weeks ago. Where do you think your dollar will go to? Anyway, while I wait for your questions, let me take the opportunity to thank FX Street, as always, for hosting the webinar. It's always a pleasure to work with you guys. And you're welcome to visit Forex Crunch. That's my site. A new feature on the site is a weekly podcast that I do with Lior Cohen of Trading Energy. We talk about evergreen topics. We talk about general trading topics and, of course, what's going on in the markets. Here are also my contact details, email and Twitter. And you're welcome to download the mobile, Android, and iOS apps. I see another question. Oh, no, it's just... thank you guys as well. Let's put the chart once again. I assume most of you prefer technical analysis. Oh, thank you very much for the kind words. This is euro dollar. since somewhere in 2012. It's exactly 10%. 126. What's the updated rate? $126.09. Okay. We're standing there towards tomorrow's event. I believe we won't see too many movements because this tension usually keeps the euro a bit locked towards the event. However, volatility has really risen recently, so who knows? Anyway, this webinar, if I'm not mistaken, is also recorded, so if you missed something, if you don't have a question but just want to go back to one of the things we talked about here, you can see it on fx3.com. Just a second. Oh, great question. Great question about the Kiwi. Yeah, indeed, it's not compatible to raise interest rates and to want a weaker exchange rate. If the central bank in New Zealand can have it all, it is to raise interest rates in order to curb the potential bubble. It also, in housing, it also introduced some macroprudential tools. But on the other hand, it wants a weak Kiwi for exports. So yeah, it's incompatible. Luckily for the New Zealand dollar, we have a stronger figure on the other hand. It's Janet Yellen, it's the Fed, and even if there, in theory, there is a carry trade. It means if you buy the New Zealand dollar against the US dollar and you wait, and the exchange rate doesn't move, you get the interest rate. And the interest rate in New Zealand is 3.5%, and in the United States it's still around 0. So even if the Fed begins raising rates, it'll take quite some time for these interest rates to match each other. However, the exchange rate does fall. The expectations for tightening from the United States make the US dollar stronger. In addition, lower demand from China. It hurts more the Australian dollar than the New Zealand dollar, but we've seen commodity prices falling and falling price of milk especially. So luckily for the authorities in New Zealand, bigger forces are pushing the Kiwi lower despite the interest rate differential. I'll mention another force. The central bank itself actually intervened in the markets during August and sold a lot of 521 million New Zealand dollars. This might sound nothing in comparison to the sums we threw here around the ECB and the Fed, but the fact that the central bank is ready to intervene and has been successful at that, I think it also deters people from buying the Kiwi dollar. So the economy there is doing well, and in general, and if everything were stable, I think Kiwi dollar should have risen thanks to the interest rate differentials, but nothing is stable in this world, and so far RBNZ is successful in eating the cake and leaving it whole. Hope that answers the question. Well, it's a complicated answer, but New Zealand dollar enjoyed an excellent carry trade before the crisis, especially against the Japanese yen. Interest rate in Japan was close to 0, and in New Zealand above 8%. So as long as the world was chiming along, everything was growing. Just holding Kiwi dollars against the Japanese yen gave an excellent yield, and eventually the exchange rate also went in that direction. But when the crisis hit, these trades reversed very, very sharply and very quickly, despite the interest rate differentials. Any more questions? We have just a few minutes left. Is anybody trading the ECB event tomorrow? I'll just say it in the ECB announces its rates tomorrow at 11:45 GMT. That's 1:45 local time. No changes expected, and I don't believe we'll see any movement in the markets, contrary to last time. But at 12:30 GMT or 2:30 PM local time, Mario Draghi, president of the ECB, begins talking. I think tomorrow they're convening in Naples, in Italy, in his own home country, and not in Frankfurt. That's when the action begins. As aforementioned, you're welcome to visit and download the podcast. You can see a recording of this webinar, and there's also a detailed ECB preview on the website if you prefer the written form. Regarding the S&P, sorry I missed your questions. I don't really follow that. In general, the stock markets are going up for a long time. Is it a bubble or not? I don't have an opinion on that. How do you see the deleveraging exercise? Well, banks have deleveraged quite a bit in the Eurozone. I think they're getting close to a point where they can begin lending again. But it depends also on demand, not only on the banks. It depends on companies and individuals willing to lend. So how do you create that trust that things are going to improve? That's a tough task. The governments need to do more, that's clear, also from Draghi, and also I think so. Okay, I think our time is up. Let's wrap it up. Again, thank you, FX Street. You're welcome to visit the website. Thank you, everybody. Hope to see you next time. You can see a recording, I believe. And happy trading tomorrow and after tomorrow and afterwards as well. I think we're going to have an exciting month in general following September. And see you soon. Goodbye.